Welcome back to the exchange. Both stocks and bonds are moving today. Bond yields, I should say, are moving higher as investors head to the polls. The Dow hasn't fallen on Election Day since 2004. It's actually been pretty strong performance. The S&P and the Nasdaq haven't been down on this day since 2000, so we're keeping with recent history. Meanwhile, Treasury yields are moving higher with the 10-year closing in on its highest since July. Our next guest says this is a market discounting a Trump win. Joining me is Knapp. He's director of research at Ironsides Macroeconomics. I don't know if you want to get, Barry, there's sort of, is it discounting a Trump win? Are these trades going to ultimately be proven right? I mean, there's many layers to this, and then there's the Fed meeting coming up.
Yeah, that was a little oversimplification when I answered that question to your producer. This has a lot to do with vol as well. Both the MOVE index for fixed income and the VIX index have been decidedly elevated for the last month, looking for big moves. Once we clear the election, we've been realizing 11% vol in the S&P, and the implied vol and VIX index has been over 20. So some of this is just clearing the event and some relief rally around all that. So I don't want to, I wouldn't get too carried away with the price moves here today. Certainly the price move in treasuries following what was a weak labor market report on Friday, the push higher in yields in the belly of the curve, that was significant. And discussion of the 10-year, surely that went well, but we have a 30-year tomorrow, and a 30 years been where the real rubber meets the road around the deficit, debt, supply of treasuries, and tomorrow that 30-year auction could be really interesting.
Maybe we should show the 30-year on the screen in recent history to kind of show how that's been tracking. But you could say the market, looked past the weak headline number. No, it might be a few one-offs. Saw strong unemployment rate. Now we've got strong ISM services this morning. I mean, I take your point. Like, if we start seeing bond yields rise on weak data, there's a problem. But maybe the rise is truly because real growth is holding up okay.
Well, I'm going to give you a little wonky response to that. To be sure, the beginning of the rally began with stronger data. The revisions to GDI, the September employment report, there was nothing strong about Friday's report. You look through all those details, big downward revisions to August, a downward revision to September, and I think there'll be another big downward revision to September. But the real wonky response to this is swap spreads, which is the difference between the actual yield on treasuries and swap rates, is really negative. That is a clear indication that supply is weighing on the part of the curve least impacted by the Fed's balance sheet or the Fed's rate policy. And that's just been moving more and more negative through this whole process. The real story here is what's going to happen to spending in 2024. Rick also commented on what happened in the gilt market. That's a fascinating little episode as well. We had our trust moment 2 years ago, and everyone said, well, you can't do supply side policies, just cut taxes like Trump has been suggesting we're going to do. But last week, the gilt market rejected a tax and spend budget.
What does that tell you, Barry? I mean, if the UK can't do supply side reforms, and if they can't do demand side stimulus, then what is left for them to do?
If you start crossing off all the similarities, you come up with only one answer. Spending at 24% of GDP is unsustainable, and it needs to be cut.
They tried that, though. Did they not?
We could get that. I mean, we could get that during the reconciliation process. If the Trump, assuming he wins, if the Trump administration's primary goal is to make those tax cuts permanent, the Byrd rule provision of budget reconciliation says this needs to balance over 10 years. This is why the Bush Tax Cuts and Jobs Act had expiration dates on them. Well, if you want to make that permanent, you're going to have to come up with offsetting revenues, and tariffs aren't going to get you there.
No.
And it seems unlikely that they could integrate a tariff provision into that, or you're going to have to come up with spending cuts.
The reason I think the tariff piece of this is interesting philosophically, but tariffs would raise, I think if we did a 20% across the board tariff, it would raise 10% of the what a current income tax would raise. So in other words, we'd probably have to go to a 200% across the board tariff to replace the income tax. And that we're not even talking about raising revenue at that point.
Right. So it's spending cuts, Cal. Spending is at 24% of GDP. The post-war average is more like 20. That's the issue. And so that's how we potentially get the debt under control. But
who's we? So I'm not hearing Trump talking about any spending cuts. I mean, maybe you could say Elon Musk's reforms on the margins. Harris is not seeming to be talking about spending cuts. So how do we get spending from 24 to 20% of GDP when the biggest contributors are Medicare, national defense in a time like this, and interest costs on the debt?
Yeah, it has to run through healthcare, and clearly cutting eligibility is going to be a huge problem. So you'd have to restructure those programs away from pay for services to results oriented. I mean, it's no trivial matter. And so I'm not implying it is. This is why I would expect the bond market to come under pressure if Trump wins a second term. But it will come, I think, even under more pressure in 2025 under a Harris administration, because there's even lower probability of any spending cuts under a Harris administration. She'll probably talk some Republicans like Susan Collins or Lisa Murkowski into some tax hikes. That won't work, and people will realize spending is now locked at 24% of GDP. So we have a big problem to deal with here.